Every time the economy gets scary, the same question floods every finance forum, every Reddit thread, every conversation between people who are watching their portfolios and wondering what to do. Where is the safest place to put my money right now? And for most of the past 40 years, the answer was relatively clean. Treasury bonds, gold, cash, maybe some defensive stocks and utilities or consumer staples. Run to safety. Wait for the storm to pass. Come back when things look calmer. The problem is that in 2026, every single one of those traditional safe havens is behaving differently than it's supposed to. And most of the financial advice being recycled right now was written for a world that no longer exists. So today I want to answer the question properly, not with the answer that worked in 2008 or 2020, with the answer that the 2026 data actually supports. And I'm going to start by explaining why the old playbook is broken, because understanding why the rules changed is the only way to apply the new ones correctly. Let's start with bonds. Because Treasury bonds have been the cornerstone of the safe haven playbook for decades. The logic was simple. When stocks fall and economies contract, the Federal Reserve cuts rates. When rates fall, bond prices rise. And since the US government backs treasuries with the full faith and credit of the United States, they are essentially risk-free from a default perspective. Stocks crash, bonds rally. That's the relationship. That's the hedge. But here's what happened in 2026. When the Strait of Hormuz closed in late February and global markets went into a risk-off panic, investors did not flood into treasury bonds. They sold them. Bond yields rose, meaning bond prices fell, at exactly the moment when traditional safe haven logic said they should have been rallying. Why? Because the crisis driving the fear is inflationary. Oil above $100, fertilizer shortages, food price pressures building. All of these are inflationary forces. And inflation is the one environment where bonds genuinely do not work as a safe haven. When inflation rises, the fixed interest payment a bond pays you is worth less in real terms every year. Investors know this. And so in an oil shock, geopolitical crisis environment, as opposed to a deflationary demand shock like 2008, bonds don't provide the protection people expect. The 30-year Treasury recently hit a yield of 4.8%. That means bond prices have been falling. People who ran to bonds for safety in this crisis got a surprise. The traditional playbook failed them. Now let's talk about gold, because gold has had an extraordinary run, up 75% in the past year, hitting over 50 all-time highs, the central bank buying story we covered in a previous video. Gold is supposed to be the ultimate safe haven, and over the long term, it has been. But here's what happened in a single session in early 2026. Gold dropped 4% in one day. Not because the geopolitical situation improved, because some of the central banks and investors who had been buying gold as a reserve asset needed to sell it to raise dollar liquidity to pay for oil. The same crisis that was supposed to be bullish for gold, the oil shock, the Hormuz closure, was simultaneously forcing some holders to liquidate gold to fund energy purchases. Gold is the strongest long-term safe haven in this environment. But it is not immune to short-term volatility. A 4% drop in a single session when you expected your safe haven to be stable is not what most people mean when they say they want safety. What about cash? Cash feels safe. You can see it in your account. It doesn't go down. It doesn't fluctuate. It just sits there. The problem with cash in 2026 is inflation. If inflation runs at 3.5% to 4%, which is where the projections are heading given the oil shock, cash in a standard savings account earning 0. 5% is losing 3% of its real value every year. The number in your account stays the same. The purchasing power it represents declines. Cash is not a safe haven from inflation. It is a guaranteed slow loss in an inflationary environment. Now, cash in a high-yield savings account or a money market fund, earning 4% to 4.5% is a different story. That is actually keeping pace with or slightly beating inflation. And that distinction matters enormously. But plain cash in a checking account, which is where most people's safety money sits, is quietly being eroded. And what about defensive stocks, the utilities, the consumer staples, the healthcare companies that are supposed to hold up when everything else falls? The 2026 data has been unkind here too. Defensive sector ETFs have underperformed the broader market in this downturn because interest rates are still elevated. When the risk-free rate is 4.5%, the dividend yield of a utility stock, typically around 3%, doesn't look as attractive. High interest rates compress the relative value of dividend-paying stocks. The defensive playbook assumes a low-rate environment. We are not in one. So the traditional safe haven basket, bonds, gold, cash, defensive stocks, is partially broken in 2026 in ways that are specific to this environment, not permanently broken, not broken for all scenarios. Broken specifically for an environment characterized by elevated inflation, geopolitical oil shock, fiscal dominance concerns, and interest rates that cannot fall as fast as the economy needs them to. This is not an environment that has a clean, simple, one-asset answer, and any content that tells you otherwise is either oversimplifying or selling you something. So what does actually work? Let me give you the framework, and then the specific instruments within each category that the data supports for 2026 specifically. The framework starts with a question that most people don't ask themselves clearly enough. What are you actually trying to protect against? Because different safe havens protect against different risks. And in 2026, you are facing at least 3 distinct risks simultaneously, and they require different tools. Risk number 1 is inflation. The oil shock is pushing prices higher. The fertilizer shortage will push food prices higher in 6 to 12 months. The fiscal dominance problem, the U.S. running trillion-dollar deficits with a central bank that can't raise rates aggressively, creates a medium-term inflation risk that is higher than the pre-2022 period. If inflation is your primary concern, you need assets that either move with inflation or generate returns that outpace it. The best tool for inflation protection right now is TIPS, Treasury Inflation Protected Securities. These are U.S. government bonds where the principal adjusts with the consumer price index. If inflation runs at 4%, your principal grows by 4%. You are paid a real yield on top of that adjusted principal. In an environment where inflation is the risk, TIPS do what regular Treasury bonds don't. They protect the purchasing power of your capital rather than eroding it. I-bonds, inflation-linked savings bonds from the U.S. Treasury, are the retail accessible version of the same concept, with the added benefit of being exempt from state and local taxes. Risk number 2 is market volatility and recession. If the economy contracts, corporate earnings fall, and stock prices correct, as the 30% to 50% recession probability suggests, is a real possibility. You need something that holds value independently of economic growth. For this risk, short-duration Treasury bills are the cleanest tool available. T-bills, Treasury securities maturing in less than 1 year, are currently yielding around 4.3% to 4.5%. They are backed by the U.S. government. They are not subject to the same interest rate risk as long-dated bonds. Because they mature quickly, you are not locked into a fixed rate for 20 years. If rates change, you simply reinvest at the new rate when the bill matures, and they are liquid. You can sell them any day the market is open. For recession protection, short-duration T-bills give you the government backing and the liquidity without the interest rate risk that makes long bonds dangerous in an inflationary environment. At 4.3% yield, they are also keeping pace with inflation, which makes them genuinely safe rather than just nominally safe. Risk number 3 is geopolitical and systemic risk, the scenario where something breaks that goes beyond a normal recession, a banking crisis, a currency event, a scenario where the financial system itself comes under stress in ways that make paper assets temporarily unreliable. For this risk, physical gold remains the best tool available. Not gold ETFs, not gold mining stocks, physical gold, or gold ETFs backed by physical gold held in allocated vaults. The reason is simple. Physical gold is the one asset that exists outside the financial system. It cannot be defaulted on. It cannot be frozen by a government. It cannot be inflated away. It has held real value across every financial crisis, every currency collapse, every geopolitical catastrophe in the past 5,000 years. For the tail risk scenario, the one you hope never materializes, but that the current environment makes more plausible than it was 2 years ago, physical gold is the insurance policy. The caveat on gold, as we discussed, is short-term volatility. A 4% single-day drop is real, and it will happen again. If you need to access the money in the next 6 months, gold is not your tool. Gold is the 5+ year store of value and tail risk hedge, not the 6-month parking spot. Now let me give you the framework that ties this together, because the mistake most people make when they ask, where is the safest place for my money, is that they are looking for one answer, one asset, one place to put everything and feel safe. That is not how safe havens work. Different assets protect against different scenarios. And in 2026, the scenarios are sufficiently varied: recession, inflation, geopolitical shock, potential fiscal crisis, that no single asset protects against all of them simultaneously. The framework is simple. Divide your safe haven money into 3 buckets based on your time horizon and the risk you're most worried about. Bucket 1 is your near-term liquidity, money you might need in the next 6 to 12 months. This goes into high-yield savings accounts or short-duration T-bill ETFs earning 4% to 4.5%. This is your emergency fund, your planned expenses, your cushion. It is liquid. It is safe from default. It is keeping roughly pace with inflation. It is not exciting, but it is correct for this purpose. Bucket 2 is your medium-term capital preservation, money you don't need for 1 to 5 years and want to protect from inflation. This goes into TIPS or I bonds. You are accepting a modest real yield in exchange for the guarantee that inflation won't erode the purchasing power of the money. In an environment where 3.5% to 4% inflation is increasingly likely, this is the tool that does what cash can't. Bucket 3 is your long-term systemic hedge, money you are setting aside for 5 or more years specifically as insurance against the tail risk scenarios. This is your gold allocation, not your entire portfolio. Typically 5 to 10%, which is where institutional analysis suggests the asset is still meaningfully underallocated globally. This is not a performance bet. It is insurance. You buy it hoping you never need it. And then there is a fourth consideration that I want to add because it is the one that most financial content ignores entirely. The best safe haven of all, in any economic environment, in any recession, in any crisis, is your own earning power. The people who come out of recessions in the strongest position are almost never the ones who found the perfect safe haven asset. They are the ones who invested in skills, relationships, and capabilities during the downturn so that their income, the most reliable source of financial security most people have, either held steady or grew while others fell. A 5% yield on a T-bill is real money. A 20% increase in your earning power because you spent the recession getting better at your job while your competitors froze is transformational money. These are not mutually exclusive. Both can and should happen simultaneously. But the allocation of time and energy into skill development during a recession is the highest returning safe haven most people are not considering. So to summarize the answer to the question everyone is asking, the safest place for your near-term money in 2026 is short-duration treasuries, or a high-yield savings account at 4% to 4.5%. The safest place for your medium-term capital against inflation is TIPS or I bonds. The safest place for your long-term tail risk hedge is physical gold at 5 to 10% of your portfolio. And the highest returning safe haven in any economic environment is your own skills and earning capacity. The old answer, run to long bonds and park in cash, is not wrong in all environments. It is wrong in this one. An oil shock with inflation risk is a different kind of crisis than the deflationary demand shock of 2008. And the tools that worked in 2008 do not fully work in 2026. The new rules require a more nuanced toolkit, but the toolkit exists, and now you have it. So here's where I want to hear from you. In this environment, which of these safe havens are you actually using? Are you A, sitting in short-term T-bills or a high-yield savings account and feeling reasonably comfortable, B, holding gold and feeling like that's the real protection, or C, staying, mostly invested in equities because you think the recession won't materialize and the recovery will be fast? Drop it in the comments, because this is one of those questions where the right answer genuinely depends on your specific situation, and I want to see where people actually are.